Common Sense on Mutual Funds. New Imperatives for the Intelligent Investor by John C. Bogle. Your reader is Grover Gardner. Chapter 1. On Long-Term Investing. Investing is an act of faith. We entrust our capital to corporate stewards in the faith, at least with the hope, that their efforts will generate high rates of return on our investments. When we purchase corporate America's stocks and bonds, we are professing our faith that the long-term success of the U.S. economy and the nation's financial markets will continue in the future. When we invest in a mutual fund, we are expressing our faith that the professional managers of the fund will be vigilant stewards of the assets we entrust to them. We are also recognizing the value of diversification by spreading our investments over a large number of stocks and bonds. A diversified portfolio minimizes the risk inherent in owning any individual security by shifting that risk to the level of the stock and bond markets. America's faith in investing has waxed and waned, kindled by bull markets and chilled by bear markets, but it has remained intact. It has survived the Great Depression, 2 world wars, the rise and fall of communism, and a barrage of unnerving changes, booms and bankruptcies, inflation and deflation, shocks in commodity prices, the revolution in information technology, and the globalization of financial markets. In recent years, our faith has been enhanced, perhaps excessively so, by the bull market in stocks that began in 1982 and has accelerated, without significant interruption, toward the century's end. As we approach the millennium, confidence in equities is at an all-time high. Might some unforeseeable economic shock trigger another depression so severe that it would destroy our faith in the promise of investing? Perhaps. Excessive confidence in smooth seas can blind us to the risk of storms. History is replete with episodes in which the enthusiasm of investors has driven equity prices to, and even beyond, the point at which they are swept into a whirlwind of speculation, leading to unexpected losses. There is little certainty in investing. As long-term investors, however, we cannot afford to let the apocalyptic possibilities frighten us away from the markets. For without risk, there is no return. The alternative to long-term investing is a short-term approach to the stock and bond markets. Countless examples from the financial media and the actual practices of professional and individual investors demonstrate that short-term investment strategies are inherently dangerous. In these current ebullient times, large numbers of investors are subordinating the principles of sound long-term investing to the frenetic short-term action that pervades our financial markets. Their counterproductive attempts to trade stocks and funds for short-term advantage and to time the market, jumping aboard when the market is expected to rise, bailing out in anticipation of a decline, are resulting in the rapid turnover of investment portfolios that ought to be designed to seek long-term goals. We are not able to control our investment returns, but a long-term investment program, fortified by faith in the future, benefits from careful attention to those elements of investing that are within our power to control: risk, cost, and time. The financial media provide a good place to begin our review of the eternal search for market-beating returns, whether through market timing or other means. The media reflect the actions of the financial markets, which are determined by the investment decisions made by all investors. The media also magnify the impact of market actions by highlighting, and in some respects sensationalizing them. Consider 2 covers from Business Week, one of our nation's most respected business periodicals. On August 13, 1979, Business Week ran a cover story called "The Death of Equities." The story's timing could hardly have been more unfortunate. The Dow Jones Industrial Average of stock prices was at 840 when the article was written. It rose to 960 by the end of 1980. In the next 2 years, the index declined. It scraped 800 in July 1982, but then rebounded to 1,200 by May 1983. Business Week then ran another cover story called The Rebirth of Equities on May 9, 1983, after the near 50% market rise that had ensued since the August 1979 article. After the publication of the 1983 article, I said to one of my colleagues, "Watch out, the fun is over." And the equity market fun was sidetracked, if only for a while. Business Week said sell when the Dow Jones Industrial Average was at 840, and buy after it had climbed to 1,200. Yet 2 years after the buy recommendation, in May 1985, the Dow still languished at about 1,200. It may be unfair to single out these Business Week classics. Time gave us an equally poignant example of the hazards of taking strong and unequivocal stands on the future course of the stock market. In its September 26, 1988 issue, Time ran a cover story titled, "Buy Stocks? No Way." The cover pictured an enormous bear. The article included these pearls of wisdom about the stock market. "It's a dangerous game. It's a vote of confidence that things are getting worse. The market has become a crapshoot. The small investor has become an endangered species. The stock market is one of the sleaziest enterprises in the world." When those words were published, the Dow Jones Industrial Average was at the 2,000 level, down from the peak of 2,700 reached just before the market crash of October 1987. Since then, the Dow has topped 9,000, greater than a fourfold increase. Investors who acted on Time's conclusion would have sat mournfully on the sidelines through one of history's most powerful bull markets. I intend neither to slam Business Week and Time nor to offer them as the perfect contrary indicators, those wonderful sources whose advice is so consistently wrong that we can count on profits simply by doing the opposite. My point is, the market is simply unpredictable on any short-term, month-to-month, or even year-to-year basis. We should not expect it to be predictable, nor should we base our investment decisions on impulses inspired by the conventional wisdom of the day. Whether they come in large headlines in respected publications or arise from our own daily hopes and fears, these calls to action generally have a short-term focus that muddles our view of the long term. Unfortunately, the available data suggests that, rather than ignoring the impulses engendered by the press or by emotional responses to market swings, the individual mutual fund shareholder responds to them with alacrity and follows the crowd. Mutual fund investing has proved to be extremely market-sensitive, as fund shareholders overreact to fluctuations in stock prices. The stock market crash of October 1987 caused many otherwise rational investors to abandon the stock market. But as soon as the bull market resumed its rampage, these same investors changed their course again. Cash flows into equity funds resumed in full force and remained positive in each quarter through mid-1998. What began as a tiny trickle became a roaring river. Net purchases of $1 billion in 1983, the first full year of the bull market, multiplied more than 200 times and reached $219 billion in 1997. If massive mutual fund inflows and outflows from investors remain contrary indicators, the industry's recent cash inflows may not be good news. But whatever the future may hold, these figures are one more manifestation of one of the great paradoxes of the stock market. When stock prices are high, investors want to jump on the bandwagon. When stocks are on the bargain counter, it is difficult to give them away. It is not only in their love-hate relationship with equity funds that investors reflect their short-term orientation. They have come to adopt another short-term strategy: rapid turnover of their equity fund holdings. The tendency of investors to follow high turnover policies in their own mutual fund portfolios has reached staggering proportions. No doubt fund investors came by this short-term philosophy honestly. They learned it from the portfolio managers who run the funds they own. From the 1940s to the mid-1960s, annual portfolio turnover of the typical general equity fund averaged a modest 17%. In 1997, average turnover of U.S. equity funds stood at 85%, an amazing five-fold increase. Portfolio managers, on average, were holding the stocks in their portfolios for only slightly longer than 1 year. It was odd behavior for investment advisors, who are entrusted with the fiduciary responsibility to manage clients' assets prudently. Instead, they were shuffling through their portfolios like short-term speculators. During the past few decades, abetted by the proliferation of sophisticated communications technologies, portfolio managers of other people's money have adopted a new method to try to beat the market. Rapid-fire trading, a practice that can burden investors with enormous portfolio transaction costs, as well as staggering tax costs. As Columbia Law School professor Louis Lowenstein expressed it in a 1998 article, mutual fund managers exhibit a persistent emphasis on momentary stock prices. The subtleties and nuances of a particular business utterly escape them. Despite the example set by some of what I describe as the best practice mutual funds, those that follow relatively steady, low-turnover policies, the mutual fund industry pursues a far less productive path. Fund managers also ignore the lesson of long-term investing set by Warren Buffett, without doubt America's most successful investment manager. The turnover in his huge portfolio, limited to a relative handful of stocks, is not only low, it is virtually non-existent. One might well ask, why should any fiduciary behave differently from the Buffett principles? Mr. Buffett describes his extraordinarily productive investment approach as keeping most of our major holdings regardless of how they are priced relative to current intrinsic business value. A till-death-do-us-part attitude. We are searching for operations that we believe are virtually certain to possess enormous strengths 10 or 20 years from now. As investors, our reaction to a fermenting industry is much like our attitude toward space exploration. We applaud the endeavor, but prefer to skip the ride. Mr. Buffett doesn't cotton to the high turnover that characterizes mutual funds. Investment managers are even more kinetic. Their behavior makes whirling dervishes appear sedated by comparison. Indeed, the term institutional investor is becoming one of those self-contradictions called an oxymoron, comparable to jumbo shrimp, lady mud wrestler, and inexpensive lawyer. Given this situation as it exists in the modern mutual fund industry, Mr. Buffett quickly comes to the correct conclusion. An investor who does not understand the economics of specific companies but wishes to be a long-term owner of American industry, he says, should periodically invest in an index fund. In this way, the know-nothing investor can actually outperform most investment professionals. Paradoxically, when dumb money acknowledges its limitations, it ceases to be dumb. Money invested for the long term, like the proverbial plodding tortoise, wins the race over speculative money, analogous to the fits and starts of the hare. The mutual fund industry is ignoring this truism. Let's consider whether the fund industry's rapid turnover might possibly be the side effect of well-executed plans for earning superior investment returns. The obvious answer is, for the industry as a whole, it cannot be. Now controlling 1/3 of all stocks, fund managers are largely trading, not with other investors, but with one another. Thus, each trade balances out for fund shareholders as a group. It is a zero-sum game. But, importantly, money is left on the table for the dealers executing the trades, meaning that the activity becomes a negative-sum game. The evidence confirms this conclusion. A recent study by Morningstar found that few managers were able to improve returns significantly through portfolio turnover, but that on balance, the tiny increases in return that turnover might have engendered were gained only by buying riskier stocks. The study hardly serves as an encouraging defense of the industry's high turnover policies. Further, my own, admittedly anecdotal studies over the years suggest that the Morningstar results may be too optimistic. The evidence that I have seen shows that the overwhelming majority of funds would earn higher returns each year if they simply held their portfolios static at the beginning of the year and took no action whatsoever during the ensuing 12 months. Whatever the cause, professional managers have fallen further behind the market averages with today's high turnover practices than with the low turnover practices that were long an industry hallmark. I suggest that the high costs imposed by their manic trading are in part responsible for this growing gap. In this exceedingly creative industry, we will no doubt witness the development of countless new short-term strategies, each with an alluring but ultimately vacant promise that hyperactive short-term management of a long-term investment portfolio can generate better results than a sensible buy-and-hold approach. Market timing has thus far been a singular failure, and the rapid turnover of investment portfolios has been no more effective. As costly and tax-inefficient turnover accelerates, for funds and fund investors alike, this practice seems destined to become ever more damaging. In my view, market timing and rapid turnover, both by and for mutual fund investors, betray both a lack of understanding of the economics of investing and an infatuation with the process of investing. As I shall make clear in Chapter 2, the source of long-term financial market returns is easily explained. For the stock market, corporate earnings and dividends. For the bond market, interest payments. Market returns, however, are calculated before the deduction of the costs of investing, and are most assuredly not based on speculation and rapid trading, which do nothing but shift returns from one investor to another. For the long-term investor, returns have everything to do with the underlying economics of corporate America, and very little to do with the mechanical process of buying and selling pieces of paper. The art of investing in mutual funds, I would argue, rests on simplicity and common sense. If individual stocks derive their value from the businesses that issue them, then the broad stock market obviously represents not a mere collection of paper stock certificates, but the tangible and intangible net assets of American business in the aggregate. Before taking costs into account, investors will inevitably earn long-term returns that approximate the earnings and dividends produced by corporate America. Rapid turnover can ultimately produce no value for investors as a group, for it does nothing to increase the level of corporate earnings and dividends. Nor can market timing have any effect on the intrinsic value of corporate America. The ideal for the long-term investor remains a sensible balance of stocks and bonds held through the market seasons of growth and decline. Although most investors have yet to embrace the ideal of long-term investing, it is surprisingly easy to achieve. In the real world of mutual funds, intelligent investors must pay attention to the elements of long-term investing that are within their power to control. No matter how difficult or how much easier said than done, they must focus not on the market's short-term direction, nor on finding the next hot fund, but on intelligent fund selection. The key to fund selection is to focus not on future return, which the investor cannot control, but on risk, cost, and time, all of which the investor can control. Just as the garden's fledgling shoots develop slowly and blossom over the course of a season, with their roots strengthening over years, investment success takes time. Give yourself all the time you can. Begin to invest in your 20s, even if you invest only a small amount. Nourished by the miracle of compound interest, your portfolio should flourish with the market's passing cycles. Over a 10-year period, for example, if market returns average a nominal 10% annually, an initial investment of $10,000 will grow to almost $26,000, more than 2.5 times the initial investment. Assuming a real return of 7%, the terminal value would represent a near doubling of your initial purchasing power. In 50 years, assuming the same 10% return, $10,000 would grow to almost $1.2 million, or 120 times the initial investment. To exploit the full power of compounding in real markets, pay particular attention to the negative implications of cost. The cost of investment advice, portfolio management and administration, buying and selling investments, and taxes. By the end of the period over which you accumulate your retirement nest egg, the returns earned in individual diversified portfolios are almost sure to lag behind those of the markets in which they invest in direct proportion to the expenses and taxes they incur. Superficially small differences in annual returns, extended over long periods of time, will make a dramatic difference in how much capital you finally accumulate. Give your portfolio plenty of time to benefit from the magic of compounding and minimize the costs you incur. Never forget that costs, like weeds, impede the garden's growth. These simple principles are the basis of a long-term investment strategy that should reward investors' faith in the promise of investing. Most mutual fund investors who deviate from the long-term investing ideal are rewarded only with dashed expectations. The relentless pursuit of unrealistic performance, practiced through costly short-term strategies, distracts them from one of the most important secrets of investment success: simplicity. As they complicate the process, they increase the likelihood of stumbling down an ill-lit path to disappointment. Follow a simple plan and let the cycles of the market take their course. The secret of investing is, finally, that there is no secret. We have had a long spring and summer, the longest sustained equity bull market in history. But there are also fall and winter. Don't be surprised when the season changes, for change it will. Indeed, that time may now be in prospect. In the long run, however, your investments will survive and prosper if you rely on a few simple rules. Invest you must. The biggest risk is the long-term risk of not putting your money to work at a generous return, not the short-term, but nonetheless real risk of price volatility. Time is your friend. Give yourself all the time you can. Begin to invest in your 20s, even if it's only a small amount, and never stop. Even modest investments in tough times will help you sustain the pace and will become a habit. Compound interest is a miracle. Impulse is your enemy. Eliminate emotion from your investment program. Have rational expectations about future returns, and avoid changing those expectations as the seasons change. Cold, dark winters will give way to bright, bountiful springs. Basic arithmetic works. Keep your investment expenses under control. Your net return is simply the gross return of your investment portfolio, less the costs you incur: sales commissions, advisory fees, transaction costs. Low costs make your task easier. Stick to simplicity. Don't complicate the process. Basic investing is simple. A sensible asset allocation to stocks, bonds, and cash reserves, a selection of middle-of-the-road funds that emphasize high-grade securities, a careful balancing of risk, return, and, lest we forget, cost. Stay the course. No matter what happens, stick to your program. I've said stay the course 1,000 times, and I meant it every time. It is the most important single piece of investment wisdom I can give to you. Let the brief and uncertain years roll by, and face the future with faith. Perhaps a future winter will be longer and colder than usual, or a summer will be drier and hotter. In the long run, however, our economy and our financial markets are stable and rational. Don't let short-run fluctuations, market psychology, false hope, fear, and greed get in the way of good investment judgment. Chapter 2. On the Nature of Returns. Occam's Razor. The preacher Ecclesiastes said, "There is no remembrance of things past, neither shall there be remembrance of things to come." That philosophy is doubtless sound for investors concerned about the erratic, unpredictable, short-term volatility in the U.S. financial markets. But in developing a long-term investment strategy, remembering the past is essential, because it can help us to understand the forces that drive security prices. When we subject financial realities to reasoned analysis, we gain insights into the sources and patterns of the long-term returns produced by stocks and bonds in the past. Those insights can provide a sound basis for determining the nature of future returns. What is more, they can form the basis for rational discourse about investing in the years ahead. Sir William of Ockham, a 14th-century British philosopher, is responsible for the insight that the simpler the explanation, the more likely it is to be correct. This postulate has come to be known as Occam's razor, and I have used it in the analytical methodology with which I approach the financial markets. Wielding Sir William's razor, I have shorn my methodology of all complication, paring the sources of investment return down to 3 essential components. This analysis takes into account my conviction both that the performance of individual securities is unpredictable, and that the performance of portfolios of securities is unpredictable on any short-term basis. While the long-term performance of portfolios is also unpredictable, a careful examination of the past returns can help establish some probabilities about the prospective parameters of return, offering intelligent investors a basis for rational expectations about future returns. The application of Occam's razor to the financial markets is most appropriate for investors who select broadly diversified mutual funds run at modest cost, and who hold them for the long term. The full market returns presented in this chapter reflect gross returns, but investors as a group inevitably earn less. Recall the discussion of investment costs in Chapter 1. So whatever market returns we expect, we must reduce them by up to 2 percentage points or more to account for those costs. Because long-term investment returns are conventionally measured by market indexes tracking the broad U.S. stock and bond markets, my analysis has the greatest direct relevance to index funds that follow these same benchmarks. Diversified stock funds that emphasize corporations with large market capitalizations, along with funds investing in high-grade bonds, also fit nicely into this analysis. In both cases, the gap between fund returns and market returns is minimized by those funds that have the lowest costs. So, courtesy of Occam's razor, I advance a simple theory. These variables determine stock market returns over the long term. The dividend yield at the time of initial investment, the subsequent rate of growth in earnings, the change in the price-earnings ratio during the period of investment. The total of these 3 components explains nearly all of the stock market's returns over extended holding periods. By analyzing the contribution to total return of the 3 factors, reasoned consideration of future returns can take place. The initial dividend yield is a known quantity. The rate of earnings growth has usually been relatively predictable within fairly narrow parameters, and the change in the price-earnings ratio has proven highly speculative. Total return is simply the sum of these 3 factors. For example, an initial dividend yield of, say, 3% plus a forecasted earnings growth of 7% annually over the next 10 years would bring the return to 10%. A change in the price-earnings ratio from, say, 15 times at the beginning of the period to a forecasted 18 times at the end would add 2 percentage points to that total, bringing the return on stocks to 12%. The Occam's razor approach to the components of return echoes the philosophy of John Maynard Keynes, perhaps the most influential economist of the 20th century. Keynes posited these sources of financial returns. Investment, which he called enterprise. The activity of forecasting the prospective yield on the asset over its whole life, assuming that the existing state of affairs will continue indefinitely. Speculation. The activity of forecasting the psychology of the market, attaching hopes to a favorable change in the conventional basis of valuation. In our Occam's razor model, the combination of initial dividend yield and prospective 10-year earnings growth, the 2 investment fundamentals, is the analog for the Keynesian concept of enterprise, the estimated yield of the asset over its lifetime. The change in price-earning ratios is the analog for speculation, a change in the basis of valuation, or a barometer of investor sentiment. Investors pay more for earnings when their expectations are high, and less when they lose faith in the future. When stocks are priced at a multiple of 21 times earnings or higher, the mood is exuberance. At 7 times earnings, the mood approaches despair. After all, the price-earnings ratio simply represents the price paid for $1 of earnings. But as the valuation falls from 21 to 7 times earnings, prices fall by 67%. If the reverse occurs, prices increase by 200%. If there is no change in the price-earnings ratio, The total return on stocks depends almost entirely on the initial dividend yield and the rate of earnings growth. In short, the fundamentals of investment, dividends and earnings growth, are the right things to remember about things past. In the very long run, the role of speculation has proven to be a neutral factor in the shaping of returns. Speculation cannot feed on itself forever. Periods in which speculation has enhanced returns have been followed by periods in which speculation has diminished returns. No matter how compelling or even predominant the impact of speculation on return is in the short run, expecting it to repeat itself leads our expectations down the wrong road. Speculation is the wrong thing to remember as we peer into the future to consider things yet to come. The point of this analytical exercise is pragmatic. If there are favorable odds of making reasonably accurate long-term projections of investment returns, and if fundamental returns, earnings, and dividends are the dominant force in shaping the long-term returns that actually transpire, would not a strategy focused on those fundamental factors be more likely to be successful than a strategy of speculation for the investor with a long-term time horizon? Short-term investment strategies, which effectively ignore dividend yield and earnings growth, both of which are virtually inconsequential in a period of weeks or months, have almost nothing to do with investment, but they have a lot to do with speculation. That is, simply guessing at the price that other investors might be willing to pay for a diversified portfolio of stocks or bonds at some future time when we are willing to sell. I make no apology for Occam's razor, nor for the simplicity of my three-step concept of evaluating returns, even as I realize, quoting Renoir, "Nothing is as disconcerting as simplicity." To which I might add, nothing is as futile as expecting past returns to be slavishly translated into future returns on a linear basis. Too many of the complex academic investment strategies and forecasting methodologies appearing in the financial journals are entirely retrospective and, often, entirely dependent on the particular period chosen. Some of them approach witchcraft. The simplicity postulated by Occam's razor can help cut through much of the confusion that clutters investment theory. It presents a simple and rational picture of future possibilities, based largely on the lessons we can learn from the study of past returns and our view of the elements of future returns. Occam's razor will not tell us what future returns will be, but it will tell us what the elements of stock and bond returns must be to provide us with any rate of return we wish to assume. You are free to disagree with my conclusions, particularly because, to reiterate, we know that anything can happen in the financial markets, and it usually does. There is no reason for slavish adherence to even a rational forecasting methodology, for markets are not always rational. Judgment is not only permitted but encouraged. But the thrust of the theoretical exercise we have now completed is that disagreement must be fact-founded and data-based, not merely intuitive. Going through the Occam's razor exercise should help investors make intelligent decisions about where to invest their assets. If we focus on the fundamentals of investment and ignore the dross of speculation, we come to the same conclusion reached by Warren Buffett. In the short run, the stock market is a voting machine. In the long run, it is a weighing machine. There is no way for investors to avoid thinking about the future course of the financial markets. In this chapter, I have tried, above all, to put into perspective the forces that drive market returns. They are worth knowing and understanding, but we must face the reality that, even if rational analysis of the relationship between investment fundamentals and speculation in investing gives us favorable odds, and no more than that, of accurately forecasting market returns, the game may not be worth the candle for the long-term investor. After all, we would be foolish to take our investment portfolios to the betting window and wager everything on a single race, even if the odds were 8 out of 10, to say nothing of 5.5 out of 10, in our favor. Peter Bernstein and Robert Arnott reflected on this question in a recent article in the Journal of Portfolio Management. Bull market? Bear market? Should you really care? They concluded that, for most long-term investors, bull markets are not nearly as beneficial, and bear markets not nearly as damaging, as most investors seem to think. They noted, correctly, that a bull market raises the asset value but delivers a proportionate reduction in the prospective real yields that the portfolio can deliver from that point forward, while a bear market does the reverse, reducing portfolio value, which is largely offset by an increase in prospective yields, other things being equal. This being the case, what we would ideally like to see is a bull market late in the lives of our portfolios, and a bear market during the early years of accumulating them. But that's a bit of timing beyond our control. Those who believe that the market's incredible momentum will be sustained, that the huge, sustained purchases of stocks by individual investors will not slacken, and that we are indeed in a new era of global growth, will hold the line in their equity allocation, or perhaps even increase it. But those who believe, as I do, that fundamentals such as earnings and dividends matter, and that in the fullness of time some semblance of historic norms will prevail, should consider at least some modest leaning against the powerful wind that is driving the high returns in this great bull market. And those who believe that another great crash lies around the corner must consider an even larger reduction of their equity exposures. Irrespective of what the future holds, however, it seems to me that equities should remain the investment of choice for the long-term investor, the dominant component of a well-balanced asset allocation program. So, invest with intelligence and common sense. Engage in an enlightened and rational discourse when considering the future. Always have some significant portion of your assets both in stocks and in bonds. Be sparing about precipitate and extreme changes in these proportions. And be skeptical about every prognostication you are given, including mine. If you have set an intelligent route toward capital accumulation, stay the course, no matter what. With a bow to Occam's razor and the role of simple concepts, I hope I have given you a better understanding of what is fundamental and what is transitory, what is investment and what is speculation, to help you come to a rational expectation of the range of returns that both stocks and bonds can provide over the long term. Now, we can get down to the most basic element of long-term investment strategy, the allocation of our investments between stocks and bonds. Chapter 3. On Asset Allocation, the Riddle of Performance Attribution. We invest with faith in the financial markets, dividing our portfolios among distinct asset classes that blossom and wither in different seasons of the economic cycle. Following the simple logic of diversification, we seek to maximize our participation in the market's seasons of plenty, while ensuring that we survive its seasons of want. For nearly all investors, the principal asset classes of choice boil down to common stocks, for maximum total return, bonds, for reasonable income, and cash reserves, for stability of principal. Each differs in risk. Stocks are the most volatile, bonds are less so, and the nominal value of cash reserves is inviolable. In the past 25 years, we have come to frame the simple logic of diversification in terms of a rigorous statistical model developed by finance academics, modern portfolio theory. Investors almost universally accept this theory, which is based on developing investment portfolios that seek returns that optimize the investor's willingness to assume risk. Risk, in turn, is defined in terms of short-term fluctuations in expected value. In its most comprehensive form, modern portfolio theory dictates that portfolio composition should include all liquid asset classes, not only U.S. stocks, bonds, and cash reserves, but international investments, short positions, foreign exchange, and various curios, gold, for example, from the financial marketplace. Such a range may be theoretically attractive, but the basic concept need not be so complex. Indeed, more than 14 centuries ago, the Talmud prescribed this simple asset allocation strategy. A man should always keep his wealth in 3 forms: 1/3 in real estate, another in merchandise, and the remainder in liquid assets. My advice is not much different from what is recommended in that ancient body of Jewish tradition and law. Rather than real estate and merchandise, however, my focus is on the marketable securities for an investment portfolio, stocks and bonds. For simplicity's sake, I omit cash reserves, such as money market funds, from the equation. Because they tend to deliver very modest returns, such reserves should be considered as savings for short-term and emergency needs, not as investment for long-term capital accumulation. For investors, short-term bonds are a superior alternative to money market funds. Short-term bonds are relatively insensitive to interest rate fluctuations. Long-term bonds are hugely sensitive. Most of the examples presented in this book are based on intermediate-term and long-term bonds. Like the Talmud's asset allocation advice, my guidelines are simple. As a crude starting point, 2/3 in stocks, 1/3 in bonds. From the day I began my career in this business, I was imbued by my mentor, the late Walter L. Morgan, an industry pioneer and the founder of the Wellington Fund, with the philosophy of portfolio balance. Balance optimizes returns from the stock market in order to reach investment goals such as the accumulation of assets for retirement, but it holds the risk of loss to tolerable levels by ownership of some bonds, too. Despite, or perhaps because of, the long bull market in stocks that has made balanced investing seem old-fashioned and stodgy to some advisors, I continue to advocate a balanced policy today, with more enthusiasm than ever. My guidelines also respect what I call the 4 dimensions of investing. 1. Return. 2. Risk. 3. Cost. And 4. Time. When you select your portfolio's long-term allocation to stocks and bonds, you must make a decision about the real returns you can expect to earn and the risks to which your portfolio will be exposed. You must also consider the costs of investing that you will incur. Costs will tend to reduce your return and/or increase the risks you must take. Think of return, risk, and cost as the 3 spatial dimensions, the length, breadth, and width of a cube. Then think of time as the temporal 4th dimension that interplays with each of the other 3. For instance, if your time horizon is long, you can afford to take more risk than if your horizon is short, and vice versa. So far, I've described risk mostly in academic terms, standard deviation, or the volatility of monthly or annual returns. In truth, however, risk is something far more difficult to quantify. It relates to how much you can afford to lose without excessive damage to your pocketbook or your psyche. The greatest benefit of a balanced investment program is that it makes risk more palatable. An allocation to bonds moderates the short-term volatility of stocks, giving the risk-averse long-term investor the courage and confidence to sustain a heavy allocation to equities. Choose a balance of stocks and bonds according to your unique circumstances, your investment objectives, your time horizon, your level of comfort with risk, and your financial resources. How can you determine an appropriate balance for your own needs? During the accumulation phase of your personal investment cycle, when you are building assets, you are putting aside money that you would otherwise spend. It's never easy, but always essential. You invest your capital, and you reinvest your dividends and your capital gains distributions. Because you have no immediate need for these assets, you can put your capital at greater risk in pursuit of higher return. As a younger investor, you might allocate as much as 80% or more of your portfolio to stocks, with the remainder in bonds. As the later years of your accumulation phase begin, you are older and you have less time to recoup any decline in the value of your portfolio. At that point, you might limit your stock exposure to no more than 70%. During the distribution phase of your investment cycle, when you enjoy the fruits of the accumulation phase, you depend on a relatively fixed pool of capital to generate income for your needs. You are withdrawing the income generated by your investments, and you cannot afford substantial short-term loss. At the start of the distribution phase, you might reduce your stock allocation to 60% or so. As you age, you might want to cut it to 50%. Even then, earning adequate income presents a challenge. In the latter part of 1998, with blue-chip stocks yielding about 1.4%, and U.S. Treasury bonds yielding about 5.4%, a 50-50 balanced market portfolio was providing a yield of 3.3%. Given the average operating costs of the typical stock and bond fund, a similar mutual fund portfolio would yield only 2%, a reduction of almost 40% in your income. This simple calculation reinforces the giant impact of fund costs. The selection of funds in your asset allocation underlines why I repeatedly stress the vital role of fund costs in your investment decision-making process. As you develop your strategic asset allocation, account for your own financial circumstances, your age, your objectives, and your appetite for risk. It would not be imprudent for a highly risk-tolerant young investor, 25 years old or so, who is just beginning to invest for retirement, to allocate everything to stocks, provided that the investor had confidence that regular investments could be made through thick and thin. In the distribution phase, a highly risk-averse older investor who has substantial means could cut the stock allocation to as low as 30%. A key factor in that decision is the relationship between the dollars to be invested and the capital already accumulated. A young investor just beginning with, say, $150 monthly contribution to an IRA, or corporate defined contribution pension or thrift plan, has time as an ally and has very little to risk at the outset. An older investor, on the other hand, must consider both the opportunity for return and the hazard of risk on a far larger and more crucial amount of capital. The time is already upon us when a $1 million plus accumulation in a tax-deferred plan is the standard for an investor who has enjoyed a reasonably rewarding career during 40 years in the workforce. It's grand to possess skill and insight, though all of us tend to overrate our abilities in both areas. But luck, too, plays a role. Many investors are right, but at the wrong time. It does no good to be too early or too late. Tactical asset allocation, if the strategy is used at all, should therefore be used only at the margin. That is, if your optimal strategic allocation is 65% stocks, limit any change to no more than 15 percentage points, 50 to 80% stocks, and implement the change gradually. The prospect of having the skill, insight, and luck to eliminate your stock position overnight and restore it when the time is right is, in my view, patently absurd. Cautious tactical allocation may have a lure for the bold. Full-blown tactical allocation lures only the fool. What might dictate moderate shifts in tactical asset allocation? One example: concern that stocks are substantially overvalued relative to bonds. Then, investors with conviction, courage, and discipline might benefit from a bow toward caution. I say bow, not capitulation. In an inevitably uncertain world, the reduction should not exceed 15 percentage points in your equity position. If you have 65% of your portfolio in equities, retain at least 50%. If 50%, at least 35%, and so on. A little caution may represent simple prudence, and if you are relatively risk-averse, may enable you to sleep better, a blessing that is hardly trivial. One doesn't have to have investment experience to recognize the wisdom in this saying from a remarkably parallel field. There are old pilots and there are bold pilots, but there are no old bold pilots. An ideal asset allocation incorporates the two most obvious dimensions of investing, risk and return. Investment costs represent a more subtle but equally critical third dimension of investing. The idea that cost rivals asset allocation in importance is not widely shared in the mutual fund industry. After all, with stocks having earned nearly 20% annually in the long bull market and 30% annually in recent years, and with bonds yielding only about 5.5% currently, asset allocation has dwarfed cost in importance. Costs rarely amount to much more than a few percentage points per year. So industry lore has it that asset allocation must be given the highest priority. By ignoring the impact of costs, the industry implicitly argues that cost doesn't matter. Industry lore is wrong. The customary perspective for investors is to consider fund expenses as a percentage of assets. In the mutual fund field, the stated expense ratio. These ratios range from 0.2% of assets annually for the lowest cost equity funds, often as it happens market index funds, to 1.5% for the average equity fund, and 2.2% for highest cost equity funds, those in the top quartile in terms of expense ratio. Even the highest of these figures, however, tends to trivialize the impact of cost for the uninitiated. An investor might ask, does a percentage point or so really matter? A second perspective shows that it matters a great deal. Consider expenses as the percentage of an initial investment consumed over a 10-year holding period. Here, the range would be only 2.8% for the lowest cost funds, 19.8% for the average fund, and a healthy, or unhealthy, 28.1% for the highest cost funds. Converting these percentages into dollars may lend even more impact to this perspective. A 0.2% annual cost on an initial investment of $10,000, assuming that the investment appreciated at 5% annually, would cost the investor only $280 over 10 years. But at 2.2%, the 10-year cost would be $2,810. That's real money. As you can imagine, the mutual fund industry is not particularly smitten by this perspective, for it brings the cost issue into sharp relief. There is also yet another perspective on cost. Cost as a percentage of the equity risk premium. It provides the most striking perspective of all. To assess the impact of cost on the equity risk premium, let's take a simple